Welcome back to another video, everyone. My name is Kyle. I am a full-time options trader and founder of Opinicus Holdings, the premier options trading community. I wanted to jump into another video here, following up the video we posted on April 10th discussing the S&P 500 technical location, just by looking at the SPY chart here. We do have some new developments within price action. We've got some new information from Powell regarding the Federal Reserve stance on monetary policy, and we have some massive earnings upcoming this week, which is definitely going to be shaking things up. So it is time to go ahead and look at this chart again. Now, if you remember in the last video, I'll go ahead and link that below if you missed it. But basically in the last video, what we said was the market is in a massive range here, and that remains true. If we flip over to the weekly chart, we see this kind of huge range that is continuing to pan out. Now, with last week's action being very bearish, the question at this point in the near term is whether or not we're going to be retesting the March lows, the late February, early March lows down here in the 415 area. That is a question on everyone's mind. If we are going to be retesting those levels, it kind of begs the question as to whether or not this is a massive topping pattern within the SPY chart. Now, if you look, again, this is the weekly chart. If you look at our proximity to the 21 weekly moving average and the 50 moving average, we can get some kind of analogs from history here. Again, just take a quick look at how close we are to those moving averages and how they are starting to roll over with price action. Now, if we go back in time, there are two similar examples here. We've got the 2007-2008 when the market crashed, and what we see here is some similar type of action here. And the reason I wanted to bring this up was this is not a prediction or anything like that. I'm not saying that the market is going to put in this massive downward move, but more so to highlight the similarities and also to highlight the sheer amount of time that these topping patterns take. This is not an instantaneous thing. This is not an overnight thing. These type of market moves take weeks and weeks and weeks. The market is, you can think about it like a cruise ship. For a cruise ship to turn around, it can't do it like a speedboat. It can't do it very quickly. It takes a very long amount of time to turn that sucker around. It's very similar to market and how market structure actually plays out. And so just looking at this, we've got a span of, from October 06 to August 08, nearly 2 years that the market spent in this range when we compare current action to the 2007-2008 analog. Now, looking back even further, when we look at the dot-com bubble that eventually popped, very similar how the stock market and price action traded along those 21 and 50 weekly moving averages before eventually rolling over. You have basically just a massive range here, just a massive 1.5 to 2 year range. And so when we go back and look at what we're doing now, you can get a sense that if this is the start of an uglier bear market, I mean, we are just in the early innings of this thing. And so that's just something to keep in mind. Again, this is not a prediction or anything like that. I just want to kind of present the bear case here and present some alternate ideas, because I know over the past few years, many traders and investors have just been purely conditioned to be looking for that dip buying opportunity. And the reason that may be different this time around has to do with monetary policy. Now, you have to remember that monetary policy, it creates booms and busts, and that has been the case for the past 100+ years. So in 2020 and 2021, there was a super easy, quote unquote, easy Fed policy, and that brought about a major boom in markets. And now we are starting to see what the flip side of that may look like. And if I bring in this kind of chart here, what you can kind of see here, this is the Fed balance sheet. You could see Fed BS there in orange. BS means balance sheet, and then the QQQ chart. So we have an overlay here. What you could see is that the market, especially tech stocks, really followed the explosion in the Fed balance sheet, as tech names were one of the main beneficiaries of the Fed balance sheet expansion. Now, the gap between the two has certainly widened lately, but that is for good reason, because what we are about to see is an unwinding of that balance sheet. And this is not secret information or anything like that. I mean, Powell has come out point blank, and many of the other Fed speakers have come out point blank and talked about the winding down of their balance sheet. This is one of the actions they are going to take to try and get inflation under control. And so what we have here is kind of an unprecedented decline that is coming in terms of what the balance sheet is going to be look like. You can see that decline here. That is the forecast that is currently being priced in. And so with that in mind, it should be no surprise that you kind of have stocks front running what the expected move in the balance sheet is going to be. So with that in mind here, and kind of giving the big picture idea as to what could happen, let's talk about some potential levels to be watching in the near term here. Now, in the last video, on the April 10th video, I mentioned this zone, this 430, 428 kind of zone, as being a key reference point to watch. And that is still true. You've got the late January bounce there, and you've got some action from the October lows. That's key, just because people are going to be putting their stops in these areas if they're long from anywhere in here. Now, we also talked about the potential bull case from this 11% rally that we saw. And the idea was that if this was the start of another bull move, well, then this minor pullback was just a pullback into the 38% fib retracement, and maybe we would see a test of the 50% fib retracement. As you can see on the chart now, that scenario is long gone. We are now down into the 78% retracement, meaning that the kind of bull scenario, at least in the near term, is extinguished. What we have to be watching for now, especially with the kind of move that we saw here over the past 2 trading days on high volume, mind you, is a continuation into these 415 lows. That is going to be the main watch. What we have, if we go back into the weekly chart, is again a big cluster of volume all through here. The weekly chart shows a big range all through this zone, and we had the bounce there from the early March action as well. And so this is the next major level to be watching. And again, what you're probably going to have is a lot of traders and a lot of investors with their stops through this level, meaning that if price trades through this kind of 415 zone, a lot of traders that were enjoying this 11% move higher are going to be stopped out of their position if they have not already locked profits. And so that's something to be watching for. Now, should that 415 area start to fail, we've got what looks like to be a pretty large volume void down from 415 into, you get into this area, into the 400, into the 390 area. And I know that is a fairly tremendous drop from where we are currently at. We're talking about another 8 to 10% lower. And so what you really want to be cautious with is any long exposure, any bullish plays that you may have on, just in case this chart really starts to roll over more. The main sign that we're going to have that this thing is going to break down is a loss of the 415 area. So this is definitely the main key level that I'll be watching into this coming week and into the next week as well. One headline that I saw last week as it pertained to the stock market was that stocks suffered their worst day since 2020 on bad earnings. Now, that is alarming simply because we've only heard from about 20% of S&P 500 companies so far. So if that is the case and we are actually lower based on bad earnings, well, we have a much larger percentage of companies reporting earnings this coming week. I believe about 1/3 of the S&P 500 companies are reporting earnings this coming week. And so it will be interesting to see what they are saying about the economy. That is obviously going to have a large impact on how stocks are moving. Now, just from a purely technical perspective, there is not much that is bullish about the recent action. I mean, we did have this trading range, and this could have been interpreted as potentially a pivot. But what we've seen with the latest information, meaning the last 2 trading days, is this was not the pivot to be getting long. We've sliced right through that. And so our next major levels, again, 415 you want to be watching. And this zone remains relevant as well. This kind of pink zone here, we have it in the 431 to 428 zone. I'm going to continue to call that a zone, a key zone to be monitoring. So those are the areas to be watching. We've got the potential bear case to keep in mind as well, just based on historical analogs, what we saw in 06, 07, 08 on the weekly chart. Just looking again at, we were looking at the proximity to the faster moving averages, the 21 moving average and the 50 moving average, and how these things kind of rolled over and the sheer amount of time that it took to actually break down. And we had that similar analog in 99 and 2000 as well. So those are some scenarios to keep in mind. Again, no prediction or anything like that. Just want to keep everyone aware of what could potentially happen here based on what we are seeing in the chart and what we were hearing out of the Federal Reserve. Hope you guys found this video useful. If you have any questions or anything like that, feel free to leave them in a comment below or reach out to me in the Traders Think Tank, and I will see you in the next one. Thank you.